All right, what's going on, everybody? How you doing? Oh, it's Friday. Got to live it up a little. So hopefully y'all had a good day. I mean, what a gift. This market just keeps giving it away. Take what we can get. Don't give anything back. We had some topic requests from earlier in the week. So we want to go through that. And then I did a call out on Microsoft for an iron condor. It probably won't stay an iron condor, but it's a good thing to start with. And then while it uh, while it matures, that's the way I like to kind of preface a sold to open trade. While it sits in the oven and bakes, we will have an opportunity to do something else with it. So this is Microsoft. I'm on a daily. It's going to jump to the weekly for a second. You can see the range. It's pretty obvious. That is the range that we want to deal with. So if you like to trade premium, or if you think maybe you want to start trading premium, there's a couple of ways to define what your range could be. Remember, volatility always overstates the anticipated range that a market could move. I used the December 19 contracts. They have 49 days left. There was 50 yesterday, obviously. It says that we could move $39 higher or lower uh, from now. Yesterday it was in the 40s, not much changed in a day, but every day that number will get smaller. So if we just always round that number up, by the way, never round it down. I like to round it to the nearest whole dollar, but another nice tip is just to go to the nearest um, $5 level. So if it says, 37, go to 40. If it's 41, go to 45, that kind of thing. So let's just round that to 40. If we are at 518 and we add 40, then we would be at 558. If we're at 518 and we subtract 40, then we would be 40 points lower, right? So that's how you want to do that. And if you do divine it that way, that's what price is expected to close within at expiration. That's one way that you can do it. But as we were talking about earlier this week, we want to understand all of the products within the Thinkorswim platform, and that includes using this lower section. So let's just see what can we do with this lower section. I don't want futures because this is an equity product, so I do want options checked, but there are futures tools that you can use, especially if you're going to look at VIX futures, by the way, which is really handy. So we've got options. It asks what do we want to look at with these options. Right now, we'll just leave that on the average. Series, I'm going to turn them all off, and I'm going to look at the December 19 options series. And now we've got the probability of touch on all of the strikes. The probability that we touch where we're at is really high. That makes sense, right? How likely is it that we touch, say, 518 when we're at 517.95? It's probably a really high opportunity, right? High probability we're going to hit that number. But what if we adjust this and we say, what's the probability that we strike these 10 strikes? 10 strikes within the range of where we are. There's a 65% chance that we could go all the way down here to 495. And there's a 65% chance that we can go to 540. All right. So we can run the probability of touch that way. We can also put it in our columns and then we can mark out levels that way. But what else can we do with this? We can look at the open interest. So I'm going to put the strikes back to all. And we're going to turn all of the options on here for a moment. This looks really noisy, but Say you want to go get a trade, you got Microsoft as your ideal product, and you just want to know where are a lot of the options at right now. When institutions and funds have been trading Microsoft, where are they getting in? Where's their largest positions? And right now we can see that this spot, January 2026, at the 500 strike, that's where there is the greatest amount of open interest. Now, we didn't tell it if we wanted calls or puts. We just said, show us the average. We could also tell it to show us all. So now we've got the calls here and the puts here. So we can define where's the greatest amount of open interest right there. What is that? And if you just stop, let the mouse get caught up, it should tell you. It's not, there it is. January 16, 2026, 500 strike call options. That has the greatest amount of open interest. Or we got these, right? The 520 strike, and then these, the December 19 and the January 16. So you can find out a lot about where there's a lot of open interest by doing this. Of course, we don't have to just use open interest. We could look at volume today, all of the options, call side, put side. Where's the greatest amount of volume showing up? Right there. Well, what is that? The October 31st today, 520 strike calls are getting the most volume today. So, as you can imagine, this is really useful. We got the totals right here. We also had the totals here, right? So it's not like we necessarily have new information, but you don't have to keep jumping back and forth between the two. You can just set it where you want. And of course, you can zoom in. So you don't have to sit there and squint at all of this and then just get back out of it when you're done. So you can really hone in on a particular expiration or just one side. If you want to make the grid bigger, we could tell it not to show all, but only show calls or only show puts, only the out of the monies if we want to go that route. We're in complete control. So we've got volume, open interest, we have extrinsic value. Of course, you have to know a little bit about options to understand what it's showing here, but only options that are, uh, well, let's say it another way. When the option is in the money, it has intrinsic value and it has extrinsic value because it's got time and other things in it. But if it's out of the money, it doesn't have any intrinsic value. It only has extrinsic value. Or we can look at the implied volatility of the different expirations, the different strikes, to see if we have any sort of risk curve or skew smirk or anything like that. So this lower section gives you an ability to look at a lot of the options within the options chain all at once. Because as you can imagine, if you were going through here for every single individual option, trying to find what you want in the options chain, that could be a real mess. It would just take a long time, and we're all in a hurry trying to get our trade on. We need to get the information that we want relatively quick. You don't need every single one of these settings. I would say most people are going to really want to focus on the open interest, the volume, and maybe the implied volatility. Maybe. Volume and open interest are going to be your greatest allies in this lower section to hone in on specific expirations and where the greatest amount of trading activity is happening in that expiration. The other section that I jumped over, I wanted to wait until the end of it, is the options time and sales. This is fantastic, especially if you get an alert. Those tradie tick alerts that are in the Discord, sometimes it's hard to tell if a trade was bought to open or if it was sold to open. And I don't like not knowing. Really, I don't. I want to know, hey, was this bought to open or sold to open? And I want to know how aggressive was it? So that what I like to do is if I see an alert, I come in and I bring up the options chain, time and sales, and then I go in and I look. So I've got Microsoft here. Uh, I want to clear the filter. Of course, you can look at calls and puts, or just calls, or just puts, all the series, all the strikes. One thing that I like to do if I'm just hanging out on the day and I'm not necessarily looking for something in particular, set the minimum to 5 because we get so many single lot trades, just one call, one put, one call, one call, one put, one call. Eliminate that noise and things slow down a little bit. Then go to conditions and do don't even check anything, just check conditions. And what that should do is eliminate most of the ones that say condition. So this white one is maybe a spread, maybe because it's white. Otherwise, if yours is green and red, mine's blue and orange, but green will be options that were bought and red will be options that were sold to open or for the trade. Let's not even say to open because we have to look at the open interest to know. We just know that a transaction happened and it was initiated as a buy or it was initiated as a sell and a trade happened. Because of course you got a buyer and a seller. There's always going to be a seller to that buyer and vice versa. But how was it initiated? So when you bring up the time and sales, you can click on quantity and you can sort it by the biggest trades that took place. There's a lot of information here. You can see what time of day that it happened. Unfortunately, this is set to your local time zone. So on the screen, you'll notice there was trades at 8:59 this morning. No, there wasn't, right? It's options. There was no options being traded on Microsoft at 9 o'clock this morning. That's my local time. That was at 10 o'clock this morning. So you got the time that the trade happened, whether it was a call or a put, what the quantity was, what the price of the option is, and then the market price. Now, that market price to me is really expensive because this is how we get to define, hey, was they hitting that at the ask and above, or was they hitting it at the bid and below? So if I look at this and it says 1,000 contracts were bought because it's blue on the ask at 16 cents. Well, what was the bid and the ask at the time? The bid was 15, the ask was 16, and they paid 16 for it. So they were paying the penny price for it. They didn't try to haggle or negotiate or try to get a better price. If you come in and you're looking at options and it says that they paid 14.60 and the ask was 14.55, they really paid up for it. They were willing to jump ahead of the entire crowd and pay 5 cents more just to make sure they got filled. It's very aggressive. And that gets my attention. But you don't normally see that in alerts. You have to go in and see it in the details. That's the details that I'm looking for. Aggressive buys or aggressive sells hitting at the ask and above or at the bid and below. So obviously quantity is a big deal, seeing big numbers come in. The thing is, they know that. They don't always come in and slap the table with a very large order. They might come in and run 50s and they'll run, 35 orders, 50 lot, 50 lot, 50 lot over and over and over and over and over again. Well, that's really big too. They just broke it up into 50s to try to slip it under the radar a little bit. The algos are getting smarter and smarter, and their ability to trade is getting more and more sophisticated. So they can run in with a 3 lot program and just run 3 lots over and over and over and over and over. And they're just buying threes over and over, and it doesn't show up as a big trade. It'll sneak right by. So now there's a lot more companies like Trady Ticks and Tasty Trade what they do is they monitor for those kind of trades to happen, and they'll gather them all up together and show you, hey, this was a block or this was a sweep. It was one actor, it was one firm, and they just bought, you know, 3,000 contracts, but they bought them in 3 lots or 5 lots. So that's why sometimes paying those prices for Tradie Ticks and Spot Gamma and those guys, it can be worth it because they've got the algo to go in and reconstruct the time and sales to show you that a trade happened, like a block or a sweep, and catch that. You can do it on your own because the time and sales has sub-second values. It doesn't just say, hey, the trade happened at 8:30. It was at 8:30:01. So if I see a 10 lot or a 20 lot and it happened at 8:30:01 and I see 25 of them hit before 8:30:06 or 8:30:08, that's less than 1 second. If they fill 10 orders at 5 lots each in 1 second, you know that was one actor, that was one trader. That's a really good example of being able to put some of the pieces together. So the time and sales, you can get more specific using the filter. You can. And if you're just shopping around, the filter can be helpful. You can use it to target only out of the money options or maybe only in the money options, do something like that. Generally, though, I leave it open where it's going to show me most of the things that I want. I just bump the quantity a little bit. That way it's not moving very fast. And then if needed, I adjust only the calls or only the puts, or I'll adjust the expiration to hone in on a particular area of options. Most of the time, though, I want to see everything we have just so that I can see what are they trading, to even know where to begin to focus. When you put this information together with this information, then you can go in and you can better understand these options that are being traded. 47% of all of the calls traded today were out of the money between 0 and 20 delta, and they were hitting 50% of them was a spread. Well, what about the other 50%, right? We could use this time and sales to better understand where these were being traded and even use the lower portion to help us better define where on the date and time curve they were trading, right? Because we can go down to that product depth and try to find that volume down here in whatever expiration is that we want, right? So that's the lower portion of the Thinkorswim options tab. Now back to this Microsoft trade. You can do the math, especially when it's easy numbers like this one, it's 40 points. Go up 40, go down 40. But what if we don't want to do the math? Some brokers will define the range for you, like Tasty Trade, and that's absolutely amazing when it does that. But if you're on Thinkorswim and you want to see that range, you can just come into the risk profile, put your trade in here, and really you can do it without a trade. I'm going to copy this trade, and then I'm going to just delete everything that's in here. That way I can put the trade back when we're done. All right, so right now I don't have any trade in here. I'm using the December options contract. So up at the top, I want to set this to the December options expiration, and that will change how wide this gray area is. If I change it to a different expiration, say like the January expiration, you can see it got bigger. Or if I went, to November, it would get smaller, but it's December. So I want to look at the December expiration. This is how wide the market is expected to This is how wide the market could move between now and that expiration. And it's expected to close inside this gray area 70% of the time. So if I put this same trade on 10 times over the next year, at least 7 out of 10 of those trades would work. That's the stats, right? One trade one time, well, that trade could lose because you don't have any probabilities, right? The more occurrences you have, the more times you place the trade, the more accurate the statistics are going to be. We're running a one standard deviation. That's a 70% probability, and that's our odds. If you can increase those odds, then fantastic, do that. So this is the range, and the range is overstated. If you've studied volatility, you've learned that the statistical models, when it comes to the standard deviation in volatility, is always overstated. It might say 40 points, but historically, the market moves less than that. So 35 to 37 points, not 40, which is why if we always round up and it is always overstated, then our trades have a higher success rate probability than we think they do. It might say we have a 7% at a 70% chance, but we really have like a 75 to 85% chance just because of that. So now let's put my trade back in. It looks like this. We actually picked it up for a dollar 75 in credit, not 170. So we got it for a little more. Right now it's actually trading at 175, so it hasn't made or lost anything, which is why I pointed out to people yesterday, if you didn't get it yesterday, don't worry, you'll probably have a chance to get it again. It's a $5 wide iron condor. So if we have 175, then we're risking 325. Typically, opening a sell to open trade like verticals and iron condors, you don't normally get good risk to reward. And that's because you've already got an inherent higher probability than you do for directional trades like buying calls or buying verticals. These have a higher win rate probability. And so they have a lower risk to reward metric. That's just the way it goes. So this trade has a put credit spread down here, and it has a call credit spread up here. And I want to put lipstick on a pig. I want to mark out my chart to define the break even zones so that I can visually see what my trade looks like against those candles. To do that, I'm going to screw these lines up so that they're in the wrong spot. And now I want to first click on this little hamburger here, show actions menu, set the slices to one standard deviation. That's this level here. It says one standard deviation base. So we're going to choose that. Make sure the lines actually moved and that they went to the right spot. Thinkorswim doesn't always move them the first time you tell it to move them. If you look, this is now the edges. That's the one standard deviation, and that's where the lines went. And then it marked where price currently is. So it did do what I asked it to do. I don't need current price, so I'm just going to right click on that level and delete that slice. And now I want to send that out to the charts. Okay, so I got them. If I double click and open this lineup, it's called a price slice. And if I go in and I tell that options area where we were to give me new lines somewhere else, it will delete these. I don't want them deleted. So to make sure they don't get deleted, I'm going to change their name. That's all we have to do to make sure that these lines won't get removed when I give that thing new commands. And I am going to give it new commands. So I'm going to name it, and I'm going to make sure that the name is showing up. So that's the 1 standard deviation low. And this is the 1 standard deviation high. All right. So I expect price to stay within these two red lines. And if it gets outside the lines, I expect that price will still come back in and close in these lines by expiration December 19th. So back to the Analyze tab. This time we're going to set the lines at break even, not today's break even, but break even on the day of expiration. I know it says the 20th. It's an old platform. Options don't expire on the day that you see. So if they say the 19th, they really expire on the 20th. If you're trading today's options and it says they expire on the 31st, they really expire tomorrow, November 1. The thing is, in our modern technical world, the markets don't even wait until tomorrow to get it done. But that's what they used to do because it took time. Now things happen instantaneous. The market closes and boom, your trade has already been dealt with. So in theory, they do expire today, but the platform is still showing that it won't be managed until the next trading day. So I'm going to now set those lines on the break even, which is this spot right here and that spot right there. Remember to always check. I told it to move the lines, and I want to visually see that the lines did get moved. They did, so we're good. Back to the show action, I can set the slices to the charts, and now I have these two lines. Those two lines represent what this trade has to have. We have to have we have to have price stay underneath the high and above the low. If we get outside of those, the trade is losing, and we're going to need to manage those before the trade expires if we're above or below. But here's the thing, this kind of trade can only lose on one side. So it has 325 of loss on that side and 325 of loss on this side. They both can't lose because you can't be at both sides at the same time. So if the puts are losing, the calls are winning, and vice versa. In the event you take this trade and Microsoft falls below those puts, the puts are losing, they're the ones that are in trouble. But we want to take these calls and roll them down. We don't want to fix the losing puts. We want to fix the winning calls. The reason for that is because we have a put vertical and we have a call vertical. That call vertical is winning. So roll that thing, lock in some profit, get offered more profit, and move it closer down. If you move the puts, price could fall even more. And then you got to move the puts again, and price could fall even more. And then you got to move the puts again, and price could fall even more. It can just chase you all the way down. And every one of those would be a roll on a losing options trade, which means you have to pay more and pay more and pay more. And there's still no guarantee that it's even going to get fixed. It's a sinkhole of just losing money. If you roll the winning side down, one, you lock in profit. You get to take gains. and then reopen the position. That's what a roll is. It closes one and opens another one. So during that roll, you lock in profit and then you open a new trade. When you go to open it, you can make it bigger. You can move it closer to price to get more credit. There's a lot of things that you can do with those calls to try to help offset the loss that you're getting from those puts. And that loss is a fixed number of loss. It's 325. Anything that we can do to reduce that number is a good thing. So locking in profit from the calls, that's a good start. Rolling the calls down to get more credit, that would help too. Okay? So don't mess with the puts. If price goes to the upside, it'll be the opposite way around. Leave the calls in place, roll the puts up. Now don't get too aggressive. The put strikes are all the way down here. If we was to break out, you would not want to roll the puts all the way up here in one shot, because what could happen? Well, that could be a fake breakout. Microsoft, breaks into highs and then it falls down and runs you over. So roll it up some. We're at like 483. You could go up $5 and that would put you around the 488 area, or you could go $10 and be in the 493 area. It's still way down here and not, above the 520, 530, 540 area. Roll it up some, make some money, roll it up again, make some money. All you're trying to do is get that 325 to go away. And by rolling the untested side, you could do that. This is two verticals, which means we can add options to the trade and we could end up building broken wing butterflies out of this thing. We could build extra legs onto it, and we can do so much more with it than just what it is. So that's the trade that I put on yesterday. It's in my Tasty account. Um, we're going to end up, doing something with it as time goes by. The idea is, I think that price is going to stay within this range into Christmas holidays. If I'm wrong and we break out, I'm going to manage this trade. I have no intentions of just letting it go and taking the loss. Even if you take this trade, but you don't want to manage it by rolling, there's no reason that you should take a max loss in this trade. This can only go to max loss if you stay in it all the way to expiration without doing anything about it. Well, why would you do that? Right? You can get out at any time. So if you don't want to roll, you think maybe that's too complicated, but you still want to take the trade, then take the trade and decide for yourself what is the loss that you're comfortable with. It's supposed to offer $175 max profit. So you could say, well, I'll stay in it as long as it doesn't lose more than $175. And if you did that, then you risked one to make one. That's a nice way to manage the trade. Everybody's got their own tactic, but that's a good way to go. If you take 175 and subtract it from 325, that should put you somewhere around what is that? 150? I think that sounds right. That's some napkin math. So if I'm wrong, just get the calculator out. But I think it's 150. 150 and 175 should get you 325. So you would just put your stop at, you'd actually be going the other way around, right? The stop would be 0 or maybe $1. You would give back the 175 and then that would basically make the trade at 0 price. To Yeah, let's do it this way so you guys can see it. Set your stop at $3.50. That's where you would buy to get out. Because remember, we're talking about paying the price of the trade to get out. We want this trade to go to zero. That's where we would make maximum amount of money. If it starts going up rather than going down, we're losing. Once it stops out at 350, then you've reached your risk one to make one stop out level and you want to just get out of the trade. I don't like to use stops that way, but they work. All right, so there's a lot of IV stuff down here. The IV stuff can get a little complicated. 52 week, if you're not familiar with that phrase, it just means 1 year, right? That's how many weeks there are in a year. So that's a 1 year look back at the IV's highest level, and then a 1 year look back at the IV's lowest level. The current IV is down here. Why Thinkorswim did this, I will never know. But the decimals show the IV like that. And then it shows the implied volatility down here like this. Just move the decimal over, right? I don't know why. I wish I had a really good answer, but if you bring up Microsoft and you look at the implied volatility, it's 0.2565. 2565. You see what I mean? The decimal should just be moved over 2 points to the left. So at its lowest, it was 0.18. At its highest, it was 0.52. And we're currently sitting at 0.25. Well, at 0.25, is that high IV or is that low IV? Sure, you can go to the chart and look, but the idea is we don't want to, right? If we're in the options chain, we want to just stay there in the options chain. But here we are. Let's go to a daily, 1 year. Is that IV high or is that IV low? Because that's what the percentile and rank are going to tell us. Rank isn't on that page, but that's what the percentile is going to help us try to understand. How often have we been at this level of IV over the last year? And is it high or is it low? One thing that I like to do, if you are on this chart, is imagine this is $1 and this is I'm broke, no money. You don't even have 1 penny to your name. So 0, 100. In the middle between 0 and 100, you have 50 cents. Well, now that we're talking about quarters, we can look at 75 cents and we can look at 25 cents. So these aren't perfect because I hand drew them, but if we find the IV down here, that's around 25%. If we're above that, we're higher than 25, but less than 50. If we're above this, which is 50% right there, if we're above that, then we're greater than 50, but less than 75. And then here is 75%. So you can draw the lines. After a while, though, a couple of years, you'll get to the point where you don't even need the lines. You just look at it and you're like, yeah, we're around 25% ish. But is it high or low? And what's it trending? Trending is really helpful to know, hey, is IV climbing or is IV falling? Because we can be at 25, but we could be on the way down. Or we could be at 25, but we're still on the way up and we don't know where it's going to stop yet. So you do kind of need this chart. But from the options tab, they're trying to give you a feel for where the options volatility is at, or where the stocks volatility is at. Excuse me, not the options volatility. So the IV's at 25. It's not at the highs and it's not at the lows. And currently it's 22 on the percentile. So let's look at what percentile is. IV percentile measures the frequency of how often the IV has been below the current level over the last year. If we was to treat each day equally, and that's not rank, right? This don't have rank, but you can get rank indicators. So 23 is the IV percentile. The market has been lower than our current IV around 23% of the time in the last year. That means we're pretty low. If we were high up, it would say something like, yeah, we've been below this level around 70, 80, 90% of the time over the last year. Come back to this chart. How often have we been below that level in the last year? It says around 25% of the time that we've had these occasional spikes above. I disagree with it, really. Looking at Microsoft, I would disagree. But that's what it says. That's what it's supposed to indicate for us, too. Then you've got your historic volatility. So while IV implied vol is looking ahead, historic vol is looking back and saying, what do we actually have rather than what is the options market pricing? What a lot of traders will do is look at the difference between the historic volatility, what they quote call real volatility, and they'll compare that to the implied volatility to see what the difference is. Historically, or the real vol right now is at 0.20 and implied vols at 0.25. The market's only projecting 0.05% increase. So we're not far off the mark here. If we had a really big move in implied vol, it would outrun historic vol, and then there'd be a bigger differential. And we'd be able to point out that vol has recently changed and that historic vol isn't caught up or real vol hasn't caught up. So these are slightly juicier than the market believes they are, basically. We can find some examples probably. Um, let's go to Spot Gamma. Spot Gamma has a watch list that shows you stocks with juicy implied vol options, things that would be really good to sell simply because they've got a juicier premium than they normally should have. So we can go look at one of those as an example of what that should look like. Let's go to scanners. What scanner do we want? Volatility risk premium. What is that? Volatility risk premium scanner highlights names that have unusually expensive options, indicating potential opportunities to sell premium. Perfect, right? That's exactly what we want to find. OKLO has juicy options at the 140 strike. Well, has juicy options. I think we'd want to go find our own strikes. That's the key gamma level. Then we have the delta level, the call wall, put wall, hedge wall, and the options impact. We could get our own strikes. And this market has an implied move of $11. So let's go look at OKLO options and see how juicy they are. Got a nice head and shoulders forming on the daily. About 15 points. This is at 130. That's at 115. So real vol is less than implied vol by about 0.15. Current IV 53. Now that's percentile. Current IV 130 with a percentile of 53. We've been lower than this level 53% of the time for the last year. 1.7 was the highest level it got to in the last year, and 0.8 was the lowest level that we've got to in the last year. We don't have a gamma squeeze, right? Stock sizzle isn't above 1. I'd like it above 2 or 3 if I was looking for a gamma squeeze. Volatility sizzle is low, so we don't have an increase in implied vol of note, but we do have an elevated put sizzle. 1.0 is 0. So this says we are 50%, 50% greater than the 5-day average put volume. And the put volume today is 54. So the average must be around like what, 35 or something? If we're 50% above the average price or the average options volume. 48% of those puts are between 0 and 20 delta, so they're out of the money puts, and they are spreads for the most part. So then we can say, well, where are they trading those puts? What expiration is getting hit? So we go to puts and we look at volume. The greatest number of puts being traded today is today's. That's not a surprise. And then the November 7, the next expiry out. Come on, Thinkorswim. You can do it, you little punk. All right, was being a goober, but it's there. There it is. Today again, the 135 strike. So that leads you in the right direction so that you know what expiration to go to and where to dig deeper, right? Of course, you can always just open it up and scroll. That's what I like to do a lot of times because I got to auto scroll on my mouse. Unusual options activity is unusual. You should not find it every day. And I think that's where a lot of people go wrong. They're looking for something that just isn't there because it's supposed to be unusual, right? If every time you look out the window and you saw an albino squirrel every single time, it wouldn't be unusual anymore, right? Like every day I drive down the road and there's that albino squirrel every day. Well, it's pretty common when it happens every day. So, same thing with UOA. It's called unusual for a reason. You shouldn't find it every day. But when you do find it, it should not be in doubt at all. It should be very obvious. And you want to see the more obvious, the better. That's what we want. We want it to be so much in our face that we're just like, oh man, how can you miss it? Right. So this is golden sweeps. When I go in here and I see a market getting hit repeatedly over and over and over and over again, and it's the same strike, the same expiration, and you can see the numbers change, like the options price is getting more and more and more expensive each time it's getting hit. That's an unusual options activity. But if you look in here and it's different strikes, it's different expirations, it's different sides, it's not so clean, it's not so good. Like these Amazon 250s, those look good, except that they weren't the same expiration. They went from November to January and then to October. They're all over the place. Now, as far as we know, they're rolling out of one and they're getting into another one, right? We don't know what they're doing. From here, this isn't enough, but it points you in the right direction. And then you can use all the things that we just talked about to have a better understanding of what's this large call sweep that just came in. You will know UOA when you see it after hearing it described, because it'll be the same strike in the same expiration and it will happen again and again and again. And the good ones, they happen all day long. It doesn't stop. You'll just see them come in again and again and again and again. And it just keeps going. Now it doesn't have to happen, minutes apart. You could see one and then an hour later see another one and then another one. So that by say 1 o'clock in the afternoon, you've got, six or seven by that point, but they were spread out through the morning. As long as they were blocks or sweeps or whatever it is that you're looking for, and it was repeat activity, that can fit as UOA. The best ones I've seen come in within 5 to 10 minutes of each other, and they're all really big size, the same strike, the same expiration, and they just get pounded over and over and over. And I have posted those in chat. Um, it's been a while since I did the last time, but I've done it before. I don't sit there all day long looking for these to come in. So it happens more often than I post. It's just been a while since I've been that focused on an intraday opportunity like that. Now you don't need these. Yeah, you could do it that way. We're just talking UOA, right? Like when UOA comes, it's not going to hit your radar just because it was in the high low graph, right? UOA is a very specific thing. It is repeat options activity, keyword being options activity. And you don't want to try to build a scan for that unusual options activity using a free platform like Thinkorswim. It won't do the job. The good thing is, if it is unusual options activity, it will show up in the Discord. You don't have to buy anything. So if you find a stock hitting in the high low graph, you can go to the Discord and see what kind of options activity is it getting today. Maybe it's not UOA, maybe it's just some really good options trades, like some good size big block order options trades. That's not UOA, but it's still really good info. So if we took today for an example, what's on the list in here? We got Citi, USB, HSBC, BAC, because the banks are getting hit, right? Financials, banks, they're getting hit pretty good. We could go down the list and see, are there any banks in here today that are getting hit? No, it's all Amazon. There's some Meta, Apple, App, Hood, AMD. So, nope, no banks, some chips, and the Mag 7. That's what's showing up in the golden sweeps. So we could check, the sweeps bot or stock breakouts, see if we get something in there. You can use this to complement the high low graph. These are the stocks that's showing up on your radar. Check to see if they're getting options activity of note. Generally, you can just run a scan on the Discord, pick a name, right? Like Stitch Fix. I like Stitch Fix. I have no taste, no style. I worked in the oil field most of my life, so wearing dirty, muddy clothes and a hard hat was my day-to-day job description. So Stitch Fix is nice. They give some old man like me a little bit of style. But we can run Stitch Fix and see, did we get any news? Did we get any options activity? Was it long? Was it short? Was it even today? Maybe it happened last week, right? That's September. That's a little old. So just do a little bit of research on the stock names that are showing up in the high low graph to get a better idea of what kind of activity they're getting. We don't need it, but I like to know why it's moving, right? So, W day, 4,000 options traded. That's an illiquid turd. No real size has come in today. There's really not much to see here. We'll remove today's options and next week's options. That'll offer us a little more clarity. Looks like those 250 calls and 235 puts for November are the greatest amount of options volume today. And the greatest open interest is January. So it's just more information. Oh, look, they're trying to break out again on the day. I love that scanner. It's on the list, and the stock is breaking out this 5-minute bar right now. That's awesome. ZM, new high, this bar. BAC, same thing. You got to admit that's a pretty awesome watch list. Pretty awesome scanner. EVGO is failing. That's not working out. Johnson and Johnson getting ready to make a new high on the day, on the RTH anyways. It's trying. Sorry, guys, I'm just reading something. I can't chew bubble gum and walk. I have to stop talking to read to absorb what I'm reading. Probably because my filter is less. Um, that would very likely be the reason. If yours is not set to all stocks, for an example, if you've already tightened it up to only show weeklies, or if yours is not, maybe it's showing only penny priced options. Mine's very vague for a reason, so I can just see as much as I can see. If I wanted to trade this list, then I would tighten it up and I would only show weeklies. I would only show things with penny prices. That way, it never brings me something that would not match my. Let me rephrase that because it'll still happen. The chances that it'll bring me something that's illiquid is less if I add those filters. But I'm not using this list at the moment for trading. Instead, I'm using it for market breadth. How's stocks doing today? Do I have more bulls and bears? And in what sectors do I have that bullishness or that bearishness? So that's why mine is more unfiltered, very likely, than yours is. Now, the thing about these scanners, guys, that it's a think or swim thing. And I learned this when I was still working in my day job, is how often it updates. This thing is not real time. I hope that doesn't burst anybody's bubble, but it's not live. So, this is what I mean by that. There's this central server somewhere, and then there's all of us retail traders out here, or just entities, and we have to fetch data from this server, and it's constantly happening. But they built a delay into the system. So when you put on a watch list, it pings the system and says, "What do you got? Does it meet my qualifications?" And then the clock starts ticking anywhere from 3.5 to 5 minutes before it checks again and says, "Hey, do you have anything that matches my qualifications?" 3.5 to 5 minute delay. Now you can update that at any time. You don't have to wait the 5 minutes, but you have to manually go in and trigger that update. If you don't, just stare at it for a few minutes and suddenly it'll morph and it'll change and you'll have new names. The way that I found this out, and you can do it for yourself, if you live closer to the server than I do, yours might update faster, no guarantees. But you can go to the scanner and you can set the scan, whatever it happens to be. So we'll just load mine. Gonna reset it, and then I'm gonna go in and load my high-low bull, and then hit the scanner. This is live. That one's delayed because I just pinged the server to get this data. But there's a little setting that you can click over here. Alert when scan results change. And if you have an active scanner like this and you click that button, watch how long it takes before you get a change notification. It might be a text message, it might be an email, depending on how you set up your messages. It might just show up at the top under messages. It really just depends on how you set yours up, but watch how long it takes in between each message. Now, one message one time, that doesn't count. Run that sucker all day long and then look back at what your average ping rate was. How far apart was each message? By the end of the day, you should have what, 35, 40 messages if it's updating 5 minutes ish. This thing should be changing if it was live every every minute, right? Like this thing should be changing rapidly. But it's not because it's not pinging the server every second. It's only pinging it about every 3 to 5 minutes on average. To me, it's both, right? The things that I want to swing trade, a lot of time, I want momentum in those names. Now, I don't know if you want momentum names because I don't know what kind of swing trades you want. You could be a credit spread swing trader, in which case you don't need momentum. Or you could be just buying calls or buying puts, in which case maybe you do, right? This would be stock that is getting attention, which kind of fits momentum, right? It's getting a lot of trading activity, which is why it hit the scanner. So just because we say swing trade, that doesn't narrow anything down, right? There are some really good mechanical trades that people can do that gets them familiar with trading and comfortable doing the trading behaviors. Mechanical means you don't get any input. Your feelings, your analysis, your perspective, none of that gets added into the equation. I've got some pretty good mechanical trades. For an example, it's Tuesday, it's time to buy a call in SPY. Sounds silly, doesn't it? And yet, I proved by doing it all through 2020, no less. I didn't know COVID was going to hit in 2020. I built the strategy in 2019. When 2020 got here, I went live and I ran it all year, even during COVID, through the drop and the rally. Every Tuesday before noon, I bought a call. That was the only qualifications. That and it needed to be less than $5. That was it. That was the rules. That strategy made money. I made more money than I lost that year on just that one strategy alone. It's based on an argument that as long as we're not in a bear market, you can just go long in the indexes and make money. There's been plenty of scientists that have already proven that to be true. I just took it for their literal meaning and I bought a call every Tuesday before noon. I could have chose Wednesday, could have chose Friday, it doesn't matter. I chose Tuesday before noon. And the call had to be less than $5. That was it. This was the 2020 year, right? There's January, February, COVID, and then the rally back out and that was the entire trading year. Buying a call on Tuesdays worked. Very mechanical system. Another mechanical system would be trading the expected move every week, or not every week. Let me rephrase that a little bit. I built another one for the weekly expected move. If we get to the edge on Monday or Tuesday, maybe on Wednesday, go the other direction. It's as simple as that. We hit the high this week on Tuesday. If you had went the other direction, you would be profitable. Don't do it on Thursday or Friday. That's a bad idea. It still works. If you had gone long on this Thursday because we hit the edge, it would have worked. If it's a sideways week and we don't get to the edge, well, then so what? You don't get a trade on this. You have to use a different strategy. If we're in a bear market, it's going to break right down and just keep on going. That's the way it goes, right? So the system is not designed to never lose because never losing is unrealistic, but it has a high success rate. You'll get a situation like this where you get to the edge on Tuesday, and then Wednesday and Thursday, nothing really happens. And, Friday it worked. It worked. So if you're buying a call when we're at the lows, you need price to run. That's different than selling puts. In my opinion, you're better off selling puts at the lows or selling calls at the highs. Try to do it near the money or at the money, not far out in the money, right? Not those 20 delta trades. Do it in the 40s and 50s. It'll work out better, and when you're wrong, it's a small hand slap and you move on and you make more money. So you win more often, you win more money, and when you lose, you don't lose as much. So my way's better than going way out of the money. But that strategy works really well, and there's nothing complicated about it. It is scannable. You can put it on different markets. You can apply it to all kinds of equities. So that's another strategy that works really well. My 111 strategy works really well. That can be done on SPY, the Qs. It can probably be done on equities. What are you trading? Stocks, options, futures? Options on stocks. Are you very particular about the stocks that you're trading, or are you just trading anything that happened to have been getting attention that day? Because day trading options on stocks is a hard thing to do. And if you're not picky, then it gets even more difficult. Where is your stock selection coming from? How are you identifying tradable opportunities? That was a nice reversal today, guys. It wasn't like one of our better textbook signals, but it was a nice reversal where it was supposed to turn. That's what made it nice. Okay, so you got your own core list. That's a really good thing, having a core list. That tickles. I like that. But there's always a but, right? Right. There's always a but. When it comes to the options, what expirations are you trading? I got hood up right now. I just randomly grabbed one off your list, right? Okay, so you're running the weeklies. 7 days to expiration? Oh no. No, no. Oh, no wonder you're having such a hard time. Okay, yeah, take it out at least 2 days, right? At least 2 days. 7 days is better. If you always trade next week's options at the bare minimum, this is going to help you out, right? Stay away from 0 days unless you're shorting it. If you're, selling a spread, not buying one, that'll help. Use next week's options, not this week's options. If it's Friday, I don't even like next Friday, right? If you're on a Friday and you're trading it, go 14 days. But do it like this. Here's a really good example, a real life experience, right? What should I trade? I want to trade Hood. What options should I trade? The ones that are going to be expiring 2 weeks out or the ones that are going to be expiring next week? I want to look at the liquidity to answer that question because the answer very likely is trade the monthly. Why? Because it has the liquidity I need. Okay, and I get that problem that now you've shrunk the account and you can't afford to buy them because they're too expensive. I get that. Here's the problem. Trading the bad options just because you can only afford the bad options only guarantees that you're going to lose more trades, right? Because you're trading the bad options because that you can only afford the bad ones. It is promised loss, right? It's a guaranteed loss because now you're only trading bad ones. So a good idea would be to take a time out until tax time. I'm going to assume you still have like a normal job somewhere. Maybe you get taxes, you get a little bit back because you overpaid, and that can boost your account a little bit. If your account is so small that you can only choose bad choices, stop trading. The answer isn't that you're going to get some miracle win and grow the account back out. That is never, ever, ever going to happen. So don't attempt to do that. Call timeout and focus on small account strategies because there are small account strategies like butterflies and um, sell to open trades like iron condors and verticals, short verticals. Butterflies are the cheapest. The problem is even butterflies have, a high 70% loss rate if you're running a good strategy or a 90% loss rate if you're running a regular strategy. The losses are really small. So you're doomed to failure if you continue to approach it that way. Cash accounts are screwed. Only professional traders can buy long puts and long calls and make money doing it. They're the only ones. Anybody else who attempts to do that just blows their account, either from a million paper cuts or from two or three really big bad trades. You need to be able to sell an option, to sell to open. If you can't do that and you're forced to buy calls and you're forced to buy puts and that's your only choice, you're screwed. And then compound that by only being able to choose the worst options available because you can't afford to get the right options. That's a lose lose situation. So the solution to the problem is convert that count to an account that can do verticals and spreads and or start grow the account by putting some funds in it to where you can at least buy proper options and not the wrong options. Let's put some perspective on probabilities and profit. These options that are way out of the money, 7 days to expiration, they're less than $100. Even that can be expensive, but whatever. They're they're pricey. $70 for that option. If I bought this option, what's my realistic profit for this one trade? I bought it for 70 cents. If Hood moves $2.50 higher and I day trade this thing and get out the same day, how much money can I make? The information is right in front of us. I can make this much money. So I bought it for 70. I can sell it for, try to split the mid here, 77, but more likely 74, right? I won't get 80. Nobody's going to pay me 80 for it. So you see the problem there. If you buy it for 70 and Hood moves $2.50 and you sell it for $4 profit, you only made $4. Hopefully there was no commissions that needed to be paid, because if you pay commissions now, you didn't make anything. And that's a $2.50 move. If I wanted to make 100% profit on this call that I bought, way out of the money call at 180, if I want 100% profit and to sell this at like $1.20 ish, I'm going to need the stock to make almost a $10 move. If I can hit it at the ask, which would be unrealistic, then I need a $7.50 move. It's a huge move just to get 100% profit. So those way out of the money options, really close to expiration, are the only cheap ones that you can afford, but they're almost guaranteed to lose. Now, don't get me wrong, if it happens to be something that moves like Amazon today, if it did that in the daytime, you could make some money. But how often does a move like that happen in the actual daytime? It usually happens overnight when we can't trade it. Even Hood at the open, you would have had to have blindly jumped into this at 9:30 and pay out the nose in the messed up premiums that are running between 9:30 and 9:40. But you could have made a little bit of profit in that. But it's not the right time to be trying to trade. You have to break every rule in the game to try to trade that. And you're going to lose more often than you win if you attempt to do that. And so then you're back to square one of you're damned if you do and you're damned if you don't. No, a professional trader, they can day trade options. No problem. They can get in, get out. But an inexperienced trader, no, guaranteed to fail. And small is relative. I was talking to a guy the other day and he said, "I've only got 175,000 in this account. I don't know how much I can do." These are his words, right? Not mine. "I've only got 175,000. I don't know how much I can do. I'm really limited." I mean, I've seen people with bigger accounts, but that was his day trading account, not his, longer term swing accounts. Yeah. And he said he's only got 175,000. I know. Right? That's what I was just like, okay, I don't know what to say to you. I don't know anybody that can, with no experience, trade these far out of the money options in a short duration and survive, because you have to have experience to do that. Now, is $750 acceptable for a small account? It depends on how small is small. You shouldn't be using more than, say, 30% of your overall account to take a position. And even out of that, your stop needs to make sure that you're not risking more than 3 to 5% of your position. right? They say keep your risk really small. Even if you have to use a large portion of your account to get into the trade, don't risk a large portion of your account in the trade. That becomes almost impossible for a small account trader. It is doable though. It just limits you down to stocks that are like, less than $50. And I mean, it's doable, but you gotta be an experienced trader to do it. Otherwise, if you're inexperienced, get closer to the money, get near the money, get in the money, trade those, because those will allow you to scalp basically, to get in, to get out. You're not locked in there trying to hang on for $8 moves, and you can, take profit and get back out again. Also, these out of the money options, when you are wrong, they lose brutally bad. It's brutal. If you're at the money or near the money and you're wrong and you're managing the trade, then it's a hand slap. You lose because it's a loser. You're going to lose some money, but they won't lose as badly as those out of the money ones will. Mm-mm. So take your watch list and narrow down the size of the stocks that are in that list to something less than $75 at least. Get it down below 50 if you can, and only trade those stocks that are less than $50. One condition I would give myself if I was doing it is to trade things that have 50-cent wide strikes, right? So I think XLI still has 50-cent wide. No, well, some of these are 50-cent wide. XLF maybe. There we go. So something like XLF, it has 50-cent wide strikes. The options, even near the money, are cheaper than what you can find way out of the money on like Robinhood. Um, these are more manageable, right? And stocks can get the job done. If you want to just forego options until you have the funds to trade the proper strikes, then do that. Um, I used to trade less than one share of Google and less than one share of Amazon when they were thousands of dollars. I would have like a quarter of a share, a quarter of a you know what I mean? Like a fraction of one. I didn't care if I could get a trade and make 50% profit or 100% profit. Well, you know what I mean? I don't care. I'm still making profit. So trade the things that account can afford, because that's the better answer rather than trading the bad options. And besides, stocks are less forgiving and they are wonderful teachers. They really are. Oh, yeah, you got to be comfortable losing. And unfortunately, that's a lesson that most of us struggle to learn, especially when you're new and you've only got a limited number of funds and there's no way to increase those funds ever again. Then it becomes even more scary. But hanging on for dear life, wanting it to come back, and refusing to lock in a loss is guaranteed to blow you up. It's 100% guaranteed. And I've seen even experienced traders make that mistake. That's not a new guy issue. That's a anybody issue. I've seen it happen. So now that you've got the stock size that you need. Try to filter out the sectors and industry that are higher risk. This is kind of iffy. So there's no wrong way to go, but personal choice helps. For an example, I don't really like to trade biopharma stocks or pot stocks for that matter. I will do it now, but when I was newer, I avoided those like crazy. One, biopharma is just so violent, anyways, but I don't understand the space. It's completely outside my wheelhouse. And it seems like most of those companies are running at a loss, and yet they'll get these big, violent moves to the upside. Um, Penny stocks are what we call event driven companies. They just fall and fall and fall, and then they get an event and they pop to the upside, and then they fall and fall and fall again. So, unless you're catching them during that pop, then they're just guaranteed to fall. That's just what they're going to do. So, I tend to not focus on those. For an example, CTM, that was in the list today. Kevin put in because I didn't do the watch list today. Or the Amazon Up, that's a single stock ETF, AMZU. MSAI. I'm looking at somebody. There we go. This is, look at this. It just falls and falls and falls. And then other than events, which pop it up, it just falls. That's just what these do. So you could, avoid trading things that look like that and instead focus on smaller named companies that are good named companies. Ford, AT&T, they're boring, but they're not penny stock trash. You have to be willing to take a loss. Unfortunately, a lot of people put their stop right at the place where the stop hunting is at. So then they just run down and they pick your stop and then they run away without you. And that sucks. In my stock trades, I don't like to use a stop. I would rather use an alert. All right. So before I get into any trade, I've already got an idea of where I want to get out. And you can do this on anything, stocks, options, futures, whatever. It doesn't mean that I'm going to batten down the hatches and hang on for dear life until it reaches my goal, right? This ain't make and break trading. I got an idea of what I want the stock to do, and I've got an idea of where my trade is no longer a good, valid trade, and I'm going to decide that I'm wrong. And I know those levels before I get in. So once I get in, if I'm wrong, and it goes to the point where I look at it and say, yeah, that going wrong was really the bad idea. I should not have gone long. I'm going to exit that trade. We can use XLF from today, maybe, as an example of this. So suppose I was looking at this and I went long. At what point, if this is all we have, would being long be wrong? If I'm getting in right here, well, if it got below the half, I would have to consider that I'm going the wrong direction, that my long isn't working. I know that to be true. If we break the half, a lot of times that's the end of the game right there. And it isn't about percentages, it's about looking at price and saying, is this trade still valid? Is it possible for me to still reach my goal today, this week, this month, whatever my goal happens to be? If we get below the half and I'm day trading, my chances of actually getting back to the high go down significantly. It doesn't mean that I'm guaranteed to lose below the half, but once we get down underneath that level, my chances of winning have gone down a lot. So if I'm watching my Yeah, I think that having a plan is more important than your entry. Now, that's not always going to be the case, but more often than not, I can tolerate a bad entry as long as I still have my plan and my plan is being executed. Once the plan starts going to hell, it doesn't matter how good my entry was, the plan has gone to hell. I no longer have a valid reason to be in this trade. The problem I see with people when they're trading is they never had a plan to begin with. It was just that looks bullish. Boom, they get in. Then it's, well, where exactly am I getting out? I'm not quite sure. It could go higher. Maybe I should stay in. I'm taking a little pain. Maybe I should get out. I don't know what I should do. I'm up 20%. What do you think I should do? Th- Of course, upside down. Ouch. Yeah, without a plan, what's the answer? And I promise the answer is not somebody else, because nobody else has to feel your pain. Only you can have that answer. So what I try to do before I get in is visualize, where am I wrong, right? Where am I wrong? That could be a long ways away, it could be a short distance. And then what am I going to do? Can I fade my exit? Do I have more than one? If I can fade my exit, great. Maybe I take a little off here and I'll take a little off there. I If it's stock, I don't even like to use stops. I'd rather use an alert. It gets my attention. I come in and I make an evaluation. I cut some loose, cut a little bit more loose if I have to, right? Or scale in if it's going well. That I have these planned before I get in. And if things change, I change. My plan will not lock me into place and force me to do something that I don't want. I've seen people try to blind faith say this is the plan and I'm not changing it. That's not fair either, because the market can do something that you didn't plan for. And then what? You know, you have to be dynamic. So then you say, okay, well, I had a plan, but I never expected what just happened. A ship stuck in the canal, airplanes falling out of the sky, the president invading Venezuela, who, whatever, well, I look, I don't know. I didn't expect that to happen. So now what am I going to do? Now I got plan B, right? And plan B is, okay, I got to call timeout, reevaluate this entire trade. And am I still in a viable trade? And if the answer is no, you eat the loss and you move on. It sounds easy, but it's not, and you're going to make choices that you don't like, between bad choices and worse choices. But having a plan and knowing where the line in the sand is between, is this trade still valid? That's why I was looking at XLF for an example of this discussion. If it got below half, then me going long is a bad idea and I need to get out. And it went below half today. I would have exited that day trade. I would have, depending on how much money there was, but more than likely I would have got out because, oh man, it's below 50 now. My chances of having a breakout are slim to none. And then what happened? It ran back up, it broke out, and now look, high of day. This is a really good example of, hey, it's below the half. I have no chance in hell here. Close the trade, eat a loss, and then it turns right around anyways and proves you wrong. You did. You're not wrong. You did what you were supposed to do. Executed the trade, followed the plan. You got the hell out. It doesn't matter that it didn't work, because you did it the way it was supposed to be done, the proper way, managing your risk and doing everything that was appropriate. The fact that yeah, yeah. Now, one thing that really helps out is the answer to this question: how do I increase my win rate? I know how to do this, by the way. I can't talk and type, so I had to pause there for a moment. There is a cheat code to increase your win rate. Unfortunately, everything has consequences. So when you increase your win rate, you decrease how much profit potential you have. Okay. But hear me out. Everything is on a sliding scale system, especially with options. If you want a higher win rate, you decrease your profit target and you will win more. That is guaranteed. You will win more often. If I take a trade where I get out, if that options price has made 10 cents profit, I will have like a 90 something percent win rate, right? Like 95 probably. It moved 10 cents, I'm out. Boom. I will have a very, very high win rate if I do that. Unfortunately, making 10 cents at a time isn't a very viable option. And then we have to talk about, but what about the losers? How long do I hold the losers before I get out, especially if I'm only making 10 cents on the winners? And unfortunately, you have to have a pretty big loss on the other side. Otherwise, the whiplash of just options prices as they move, you would be taking losses drastically, high loss rate too, right? So you got to have a big loss number, but a low loss rate, and a high win number, but a low profit value. But the numbers skew, right? So you want to win more often? No problem. Take profit sooner. I used the 10 cents because it proves my point. Nobody would ever hopefully consider that a valid strategy. So please don't do it. But 50 cents and 75 cents and even $1 in the options price change if you're trading SPY, that is a strategy that I know a lot of traders do. They buy a SPY call and it moves $1 and they get out, or they'll get out of most of the position and they'll leave a runner for a little bit more. And that's all they do all day long. And they're mostly dip buyers. So every time SPY gets to the low of the day, they're buying calls down there. That's just all they do. On days where we go down, they get butt hurt and they're salty and they cry a lot and they just, they try until noon and then they give up. But there's lots of communities out there that's all they do. They just call out, we're going long in SPY, and they would have done it here, and they'd have made a little bit, and then they would have done it there and they'd have made a little bit, and then they would have done it here, and they would still be bragging to their clients who are in their Discord, we killed it today, boys, we got it. And that's all they do every day. And they're looking for $1 in the change of the option of SPY. That's it, right? And I guarantee you will win more often if that's all you do. It doesn't require any real technical analysis. You're just trying to catch the pops. And if it's a day where we went up all day, well, then you're just, banking it to the upside all day. No, run them. That's easy enough. So try that approach. It's not to say that I'm against it. I'm not. I kind of talk trash on it because they act like there's some great technicians when all they're doing is buying the dip. They don't know how to recognize any day that's not a buy the dip day. And when it's not a buy the dip day, they just sit around salty and cry because they don't know how to do anything else. But it works. It's a viable strategy. And get out within, if you're not winning anything at all right now, get out at 50 cents. That's a small move in SPY to make 50 cents in the options price. It'll give you experience trading options. It'll give you experience managing the trade. You can run 1 for 1 because you'll still have a relatively decent win rate. So the losses should not exceed 50 cents. Hopefully you recognize that price is not working and you can keep the losses less than 50 cents. That's the goal. Get out before it actually hits your 50-cent stop. Manage the winners so that if you get, say, more than one contract, then you can get out at 50 cents with your one and leave a runner to see how much more you can get. And that way you can start tweaking the system. Aim for 50 cents, grow the account, move it to 75 cents, grow the account, move it to $1, grow the account. You get the idea. It does work. But there's an easier way to trade, and it just requires having a margin account. The cash account can't do it. That is an easier way to trade because it doesn't require a move in the market. And new traders fail to grasp this logic. What's easier? trying to figure out where price is going to be by next Friday, or trying to figure out where price is not going to go by next Friday. In my opinion, it's easier to try to figure out where we should not go by next Friday. And it could be that I'm seeing it all wrong because everybody sees the market differently. I think it's easier to figure out where we should not go rather than figure out where we will be. Who knows where the hell we're going to be next week, right? Like that sounds a lot harder to figure out. But where are we not going to be, or where should we not be? That's easier. So if you can bring up a stock chart and you're like, "Oh yeah, there's no way we're going to be below that level by next Friday." Well, you've got a trade right there. All right? Here's MRK. It's a good example. Should we be higher than 89 or should we be lower than 83? Well, I mean, we just had earnings, so let's ignore that. That would be one example. If we were on support, we could trade that. Or if we were at resistance, we could trade that. But unfortunately, we're right in the middle. There's no idea, right? And yet I'll see people who take this trade and they'll say, well, yeah, but it's really bullish, or it's really this, or it's in the middle of a range. And seems high risk. Can't figure out where it's not supposed to be. Can't figure out where it is going to be. What are you supposed to do with this thing? Oh, but I really like the company and I like what they do, and they got a really good social media, and they just got these new contracts from the government, and they got all these other reasons why I think this is a really good trade, and none of that crap matters. So if you're in a situation right now and your account is too small to trade, quote, the right thing, just stop. Trading the wrong thing is just going to make it worse. Go to stocks that will help. They're less complicated than options. They're also less forgiving. They offer more opportunity to grow. It's slower growth, but it gives you a chance to grow as a trader while you're growing the account. This market this year has been really hard to trade for a number of reasons. This endless grind to the upside with all of the negative market breadth signals that we continue to see is a really hard thing to chew on. We got every reason in the world to believe that it's going to go down, and yet it just keeps going higher and higher and higher and higher. And I know a lot of traders who said, yeah, I had to just break every rule that I have. Otherwise, I wouldn't have made any money this year. Staying in high flyers and continuing to run them even higher because, well, that's just what they've been doing. I brought up my account from a broker called Public. I opened this account with $20 and I don't trade options in this account. The broker does offer options. I've just never traded an option here. Um, I grew this account. It's at $1,900 now. It was higher, but I took profit. Let's see if we can see the profit when I took profit. Oh, I think it was that big dip right there when I took profit. I think so. But I took out about $500. So it went from 19 to, nope, that ain't the one, because that only went down. I didn't, what did I say? 5,000? That ain't right. I took 500 out, not 5,000. This account hasn't made it to 5,000 yet. I think that's the $500 that I took out from 19 to like 14. So no, that's not it, because that's only a $1,000 drop. Plus, it shouldn't have been slow, right? It should have happened immediately. Maybe it was this, and I don't know. I'm not seeing it. Anyways, I pulled money out So it's lower than it was. But this entire account has been grown using stocks. And if you look at the shares, the size, the holdings, I've got 1.9 shares in this. I've got 25% of one share in that. You see what I mean? Like this account is not holding hundreds of shares of stock. It's holding fractions of a share of a stock. Now, sure, I've got ONDS. I've got a couple of those, a couple of shares, but Microsoft, I don't even have a quarter of one share in Microsoft, but I've got Microsoft, right? So you can grow an account that's small. And this is not paper. I don't even know if they offer paper. I doubt it. Um, this is an account. It's my account, right? It's just one of, and it proves the point that you can start with a very small amount of money and you can grow it out. I haven't had this account for very long. Set it on a 1 year, and we just run it back to November of 2024, and it was at $400 at that point. The high this year was at 1900, and I'm not seeing my withdrawal, so it should have been like 2300, 2400, something like that. Yeah, I felt it. I had to get out of stuff to do it. And I like you trying to pick what I was going to get out of. Like, no, I don't want to get out of that. No, I want to keep that. I felt like a hoarder. I really did. Like those people that just don't want to let anything go. That's what I felt like. I like the bag holder queen, man. I didn't want to let anything go. Like, no, I want it all. But I did. I got out of what I needed to. And this, I like growing small accounts. It keeps me busy on days where, futures are trash. I go trade something else or I go evaluate what I'm already holding. And as you can see, these are all that I'm holding. And I have to click show all to show the rest. There's a lot here, right? Like that's a lot of stocks. This is one broker, one account. I've got a lot of brokers and a lot of accounts. So I stay busy, find something to do. I think you can. One of the reasons that I went to Fidelity is because of the fractional shares. And I'm pretty sure that you can do it at Schwab, but not index ETFs like SPY and the Qs. Don't get me. I know that we were going to use Schwab, and then there was like either you could only do it on the ETF spies or you could not do it on the spies. And I was like, well, never, whatever one of those it was, I was like, well, that I'm not staying here then. And so we went to Fidelity, but I can't remember which one. So I'm Googling it real quick just to check. Yeah, you can get price slices, which is what they call it, stock slices. You can buy portions of a share for as little as $5. But there's an ETF restriction, and you just got to like find what that restriction is. And I didn't know until I had put money in the account that it had that restriction. And then I was like, oh, well, hell. Um, it's on their website though. So I use Fidelity for my long term account. And of course, I came across Public, and I really like Public, but they're new. I didn't know anything about them when I first come across them. I just thought it was kind of neat, so I threw 20 bucks in it and was playing around. And I had so much fun with it. I just kept growing it. So I did not yet cover it. I knew that you had asked, and I wasn't seeing you here, and I wanted to talk with you while we did it, so I didn't do it yet. But if you got time, I've got time. Hey, Rob, have a good weekend, buddy. I'm talking to Hugo. All right. So, the question for anybody trying to follow along on what we're talking about earlier this week, one of the requests for the live stream was when picking a stock trade, what are the things or the conditions that I like to see to determine if it's a good trade or not? Now, I liked this question because if it doesn't look good, I don't care about anything else. If it doesn't look good, I'm not messing with it. Right? So I liked the question because of that. And I see people who say, hey, this had unusual options activity. What do you think? Or this is in the news and it's blowing up. What do you think? And I go look and I'm like, yeah, that looks like trash. I don't want that. I don't like it. Oh, but, and they have all these reasons why they want to trade it, but there's nothing there that I like. So I've got some conditions right off the bat on things that have to meet these qualifications. It needs to be liquid. I'm really, really picky about this. If it's not liquid, I don't want to trade it. Mostly, I mean options, but I do mean stock too. So if it's really thin stock, if there's not a lot of share float out there, if it, if that's the situation, I really not want to mess with it unless I'm deliberately playing something that's getting short squeezed. All right. It's hard to borrow and we're squeezing the hell out of the shorts. Well, then that's a very specific situation. But in general, I don't want to trade it if it's really a liquid. I try not to get into long trades if we're underneath the major moving averages. That's a bad way to go. Let me bring up these. These are my three charts that I tend to have most of my rules based around. So we're going to bring up the one on the left. I have it set to a weekly right now, but if and when needed, I will take this chart to a monthly or even a quarterly or a yearly. It just depends on, am I seeing what I need to see? So on this weekly chart, if I want to go long, I don't want to find a stock that's below the 50. If a company is below the 50, I'm not interested in long trades down there. I'll day trade it. You know what I mean? Like we're talking swing trade stuff. I don't want to buy and hold. I don't want to have it in my portfolio as a long opportunity because it's under the 50 week and it's damaged or broken in some way that investors and other firms and banks, they smashed that sucker under the 50 and they still consider it dirt or it wouldn't be down there anymore. So that's a really good rule of thumb is this particular company a quote healthy company? Is it well loved? Do investors and traders and other funds and firm have a good stake in it? Or is it just one of these that everybody's continuing to hammer this thing into the dirt? Above the 50 is a good way to go. Above the 400 week is a line in the sand between getting delisted or not. I feel bad when I see a question like that because back in the day, that's what we did every day. That's what the streams were, right? Like we bring up we traded. I don't know what Kevin does, guys. I don't know if he's trading live or if he's not trading live. I have no idea. I only work. Oh, then how do they see the work? Like when are you working the order? Or did you get filled at a good price? Did you have to adjust it? Sh- Well, seeing it done live, the The thing is, I'm only here part-time, so I'm only here on Thursdays, Wednesdays, and Fridays, and it's in the last 2 hours, which means a lot of times we don't really have anything good to trade. But I can do it on paper just so that you guys can see what I'm doing, how it gets executed, working the order. Of course, it's never going to be real on paper, even the working the order part. But there's works around just so that you guys can see the mechanics of it, the process of it, all of that. And I do trade live when I have something to trade, right? Just like most of the time, though, we're not even looking for trades. And most of the time, we're not trying to, right? You know what I mean? Like, that's just not the goal, but we can. And if there is a trade worth taking, I'm going to get on my live account and trade it. But when we just need to get trades on to get them on, yeah, we can do that in paper all day long. I still think it would show people the process and the steps and the things to focus on. Absolutely. To this other question, though, on things to look for, some of the things that we had mentioned or last week was, yeah, the short interest, the options. I like to know the why behind things. So you can look at those things, and I often check them if it's a company that I don't know. I want to know, hey, what's the short interest? As just trying to get a feel for what's been happening in this particular stock. But a lot of times, I tell you, just checking the short interest just to check it, if it's a good stock, you would never need to, right? Like AMD, Apple, Amazon, Caterpillar. I never think about looking at the short interest on those. But if I pull up a stock chart and it looks like this thing that just keeps bleeding to the downside, whatever this thing happens to be, I absolutely would look at the short interest on it because one, I don't know what it is, but two, it just keeps going down. And I'd want to be worried about a short squeeze and maybe a possible trade to the upside. The options, I do like to know if a stock is getting options activity, even if I don't want to trade the options myself, right? Because I'm really picky about the options that I will trade, but that doesn't mean that I won't look at them. So, CAT, for an example, Caterpillar, poor options. When I do trade Caterpillar, I don't mess with their options, but I do trade this company and I watch their options to see how the options are getting traded. So, looking at those are good. What's the put call ratio doing? Do we have a lot of open interest in any particular strike or expiration that I need to know about? Kind of like call walls and put walls and that sort of stuff. Yeah, we can definitely use a real example. MD, this is Mednax. Let's jump out and see what it looks like on the monthly. It's below IPO still, trying to come back from the dead after being down around $6.50. It's at 17 now, so it's working its way back up. What I would be looking at on this is where's price in a range. This is the range. Do I have a viable opportunity here? Absolutely. This is Adam Grimes' pre-consolidation breakout pattern. Would I trade it? Too close to earnings for my taste, personally. But I would be willing to build into a position just because of how cheap it is. It is above the 200 week. That's a great place to start. And it's above the 10. And as long as it's holding above the 10, then it's in trend. We can see that all the moving averages here are forked out. I like that. It's just got to get through that $18 resistance. Back to the monthly, we have that monthly Bollinger Band. Pay particular attention to those things. I'm not saying that you have to try to trade against those, to go long or go short. But big Bollinger levels like weekly and monthly, they matter. If you look at this rejection back here, it hit the 50-month and the Bollinger month high and it rejected. It could have been both of those. It could have been either one of those. It may be neither one of them. But that's where price turned around the last time we got that high. Then we punched through the 50. We never made it to the Bollinger Edge. And if we do get a move to the upside on this breakout, that Bollinger Edge is going to be a problem. It's $20. That's the round number. It's easy enough to keep your eye on. Now I'm done with the monthly. Where's the weekly? 19 and a half. That's the Bollinger top. That would be an area of concern, right? Just like that. So I would be looking at how much room do I have to the upside before I have problems that I need to deal with. A dollar and a half from 18 to 1950. Actually more than that because we're at like 17 right now. But you get the idea. Do I have any room up there? So I would be willing to build into a position like this because I like the things that I see. I like the moving average fork. I like that it's improving. I like that it's up against the resistance and it has the potential to break out and run. I know a lot of people only want things that look like they're a promised win. And don't get me wrong, if you're going to promise me a win, I'll take it. But I'm willing to take risks in a trade if I can mitigate that risk. And trading against a resistance level where it looks like it could pop out and run, I'm willing to do that because I can control that risk. If it doesn't work, I'll take a small hand slap and I'll move on. It's not a big deal. But if we were sitting in the middle of this range, I wouldn't want anything to do with it because now what am I going to do with it? We got to get to the edges to even get a breakout. And there's no guarantee that you'll even get to the edges. It could just stall out and not get anywhere. So I like to see that I have a plan. I still want to go understand, what is this company? Why did it get such a beat down? Those help. It's not to say that I'm going to have that or I won't trade, but I would want to know, like, hey, what the hell happened? Because these guys have been bleeding for 10 years and now they're turning it around. Is this just a small pop to the upside before we head down to $5? Or are we actually turning something around? That would be a really good question to answer because look, that's a lower low, and for all we know, this is a lower high. So, I'd like to have some of those answers. Yeah, I don't like to short them either. No, I'm with you. I'd rather go long in equities. Nice. I haven't seen the video yet. Was it David? Cool. I'll have to watch that this weekend. So once I've got anything that gives me the confidence that I have risk under control and that I can see the trade strategy, then I'm willing to trade that particular stock. If what I also like to see is thematics. I know it sounds really fancy, right? Thematics. It's basically says what's the theme or what's the reason, and if you can get it in a group, that's better. So pot stocks, airlines, those are thematics, and if you can tie it to a narrative, like say, um, fuel has reached the lowest level that it's reached in 5 decades, and airlines bought a 5-year contract to get oil at this price. And now airlines are going up. And now I've got a reason to get long in airlines. You know what I mean? It's not just, oh, airlines are going up, but now there's this whole narrative that fits a backstory that then that's a really good trade. And I like that more now because it's not just, oh, I see American Airlines is going up. So I want to tie it into a theme. I want to tie it to a thematic if I can. I want a very particular signal or pattern. If I have one of those, I'll take it. And then there's the time frame for the trade because I've got a lot of trades that are just 2 or 3 day trades. And there's nothing wrong with that, right? You get in, you run it for 2 or 3 days, and you get back out again. That's cool. I don't mind those at all. But if it's a longer term trade, it needs deeper research. The chart that I brought up has these moving averages on it. You can use your own. Mine aren't very special or particular, but I've got the 600, the 400, the 200, 150, I think there's a 30 in there, 20, 10, 4. The 400 is important for a weekly. The 600 is important for the daily. The 100 is important for the monthly. So every one of them kind of has their own reasons. And a lot of them is just, is this sucker broken or not? Because if it's underneath the 400 week, like we were talking about, it's not a good company. I don't want to trade it long. Or if it's above the 200, then I want to, on the 200 day, I want to see a rising 200 for a reason to think it's a good stock that might continue to go up. I want to make sure that we're not going to hit Bollinger edges, or that we had a Bollinger breakout. Because if we're through the Bollinger, well, then good. I don't have to worry about hitting that sucker. Of course, we know that that's a short lived trade because we can't stay outside the Bollingers for very long, usually. And you can stack up your checklist of qualifications and try to define for yourself, what am I attempting to trade? I'm a very versatile trader, so I trade a lot of different things. My category for what I consider, quote, good is really strict, meaning I want to know what it is. And then the options have to be good. The price chart has to be clean. It can't have a lot of big gaps and trash in it. I want to just get done with earnings so that we're on the other side of earnings for longer term trades. I don't like trading right in front of an earnings in a company that I'm unfamiliar with, because I don't know what the outcome could be. I mean, we never know anyways, right? But you usually get a feel for a company that, even if the earnings is going to be bad, but the company's a good company, that things are going to be okay, right? Like Apple can have a bad earnings, Netflix, Amazon, whatever, they can have a bad earnings and you still know they're good companies. But if it's just some Joe Schmo company, I don't know, and then they got earnings, like, oh, I don't want to trade that. A good tactic can be, start with a short term trade in stocks. And as long as it continues to perform, stay in the trade and have rules to add. I've taken trades where it was like MD. It was risk because we're right against resistance, but we're not through it yet. You start with something small, say 50 shares, 100 shares, and then it breaks through and it holds. So then I add more shares. And then it gets to the next whole dollar level and I add more shares, and as long as it continues to perform, I just continue adding more shares to it. And then if it stalls out and it goes sideways, maybe you take some shares off or you quit adding any, at least, right? There's certainly nothing wrong with that. The other approach is that you had a good reason to get in now, and you get in with size, but you take most of that size off after the initial move is done. A lot of times within the first few hours, or maybe within a day or two, because the size is just so big that it's uncomfortable. But you get in really big, it makes the first initial move, and you get most of that risk out, tuck it away, and you just leave a little bit on, and that changes your break even drastically. So you can just leave the rest, just run it. All of those metrics define how the entry is going to go. Because unlike the textbooks, where it's this very beautiful, you know, Goldilocks condition, I have rarely found those examples in the real world and have it work out the way that I expected it to. What I think will be a really good thing to do, and this one I'm going to do it next Wednesday, and it won't matter if you have to catch the replay on this one, is when I walk through a chart on what I want to see. And I'm just going to go through the Dow list on Wednesday and do it on multiple stocks so that you guys get an idea of the checklist isn't really the right word, but the process that I go through. Oh, no worries. I'm wrapping up here either way. Because I gotta get dinner on here in a minute. That's on that's gonna be QRA November 5. Well, with the old lady's procedure today, um, me quote cooking dinner is running to town and buying the pizza from Pizza Hut because she didn't want to cook. She didn't want to do any dishes. I don't mind cooking, but I don't want to do any dishes. So dinner is going to be me buying it from Pizza Hut. You know, in my early 20s, I delivered pizza for Domino's and I did it for Pizza Hut. I made more money in the wintertime delivering pizza than I did working on drilling rigs. How's that for mind blowing? Yes, sir. No coat. And they'd say, "Oh my gosh, where's your coat? I'm new. I can't afford a coat." Tip, 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 tip. A lot of tips would just come in, and I used it every time. I'm new. I can't afford a coat. Tip, tip, tip. Nah, I was banking. I can make $100 in tips in about 2 hours. I was not making $100 in 2 hours on a drilling rig. It's crazy, but that's the way that's the way it would go. Of course, it helped, when you're young and you're good looking too. When me as an old man waddling up with my broken, disabled self, they're not going to give me no tip. No. You know, at Pizza Hut, because every Friday during the summer we take the bike out, and so we always pick up Pizza Huts on Friday. They at the counter, they'll turn the little thing around and say, "How much of a tip do you want to give us?" Excuse me, I ordered the pizza. I walked into your store and I picked it up from you at the counter. Why would I tip you? Like, you know what I mean? Like, you, you didn't serve me. You didn't wait on me. You didn't do you didn't do anything for me. Why am I tipping you? Right? Yes. Now servers, I always yes. And they should be tipped. Even if they did the worst job, tell them they did a really bad job, but give them something. I mean, unless they literally dumped your plate in your lap or something, give them something. Even if you give them lip too, give them something. Because I've had some bad ones and I give them lip. I'm like, you're the worst damn server I've ever had. I'll still leave them $1 or something. Yeah.